All right, Luke, I'm super excited for this event today, this opportunity to speak to the public here. I have a question for you. You're an LP in a fund. You're a very active angel investor in Silicon Valley. You've sold your own company in the past. You've done so many things, but recently you wrote a book on profit streams. Why write that book? Why now? And could you tell us a little bit more about your background of who you are that I might have missed out that led to writing this book?
Sure. When you look at founders, many of them start as I did. I am an engineer by training. I've got multiple patents. I had worked in the tech space, and I had worked in companies that had been funded. And when I started looking at what was successful, both for the companies I was working in, they all ended up having one thing in common. You actually made a profit. You weren't trying to just get market share. You weren't trying to just raise funds or raise money from investors, but you actually had a path to sustainable profitability. And the reason we wrote the book and the reason we're focusing on profit is we're seeing a shift in Silicon Valley and other investors where they're really looking for, show me the fundamentals. Show me that you can actually make a profit from this business if you want my money.
So to show that profit, I mean, one of the things would have to be having the right price. So if you're a brand new company, I mean, so many companies here, we saw some amazing companies just now on stage. How do they go about kind of figuring out, or is it more of a guess, more of an art, that initial price?
Pricing is so challenging because money is never money for people. Money always includes some form of an emotional connection. And so startup founders, sometimes they have this sense of validation desperation, like I just got to get a sale, so I'll take any price I get. Or they'll choose pricing strategies that are based on, here are my costs. As long as I'm making enough money to cover my costs and my VCs and my investors are happy, I'm good. And what that does is it leaves money on the table because they're not actually doing the homework to say, this is the value that I'm bringing to my customers, and I'm going to charge for that value. So the common mistakes that people make in pricing are taking whatever price they can get, especially in the B2B market, or simply modeling price based on their costs as opposed to saying, this is actually the result I'm creating for you, and I'm going to charge for it.
So I'm going to circle back to that, but before then, what happens if, say on day one, they have the wrong price for their product or service? What are the pitfalls?
Yeah, there's a few pitfalls, and I don't want to imply that you can't start your company unless you're perfect, because there's always adjustments in the pricing. But one of the common mistakes that people make, especially in B2B markets, is that you're not going to find a B2B customer going to a website and just clicking through a license agreement. Most B2B customers are going to make some kind of negotiation. And those first customers and those first negotiations can be very challenging because they're going to try and insert things like a most favored nations clause, or they're going to put in limits on how much you can raise your pricing, or they're going to say things about the support and the service. And those initial contracts can really be problematic for a startup because they'll often carry through into the future. And those are things to avoid when setting up your initial pricing.
Now, you said something there that I'm not sure many people have heard before or would know, most favored nations. What does that term mean, and what are some other terms that might be red flags that could come up in a contract?
Yeah, most favored nation clause is when you sign a deal with a company and the deal says, we will always get this price or the best price that you're offering to other customers. And it can be very limiting because it removes flexibility in negotiation. There are many reasons why a startup might start with one price for their first customer and actually lower the price for a subsequent customer if there were other considerations in the deal. So what you want to look for as a startup is you want to maximize your negotiation capability in the pricing that you're making.
If you want to maximize your negotiation capabilities, as a startup, do you actually have any of that power to do so?
Startups fall into a trap where they tend to think that they're weaker than they are. And if you looked at some of the startups that we were talking about today, they actually have a solution that's important. And contrary to popular belief, larger companies that are working with startups, they don't really want the startup to fail because it's really problematic for a large company to start working with a smaller company and have it fail. I found that in my own company when I started making the biggest deals that we were making, deals in excess of $1 million ARR for a single deal with a single company. They didn't want us to fail. They wanted us to be around. And so you want to actually look at the negotiation leverage that you have. You want a fair price, but you also want to go into that negotiation with enough strength about what you're offering to that larger customer because they don't want you to fail. They want you to stick around.
Are there ideas or suggestions on that negotiation, that contract, that could help the startup or the company with their pricing over time?
A couple of things that are really important for startups is, first, make sure that you get a lawyer or a legal firm or a legal team that actually understands something about software and software pricing and negotiation. We see too many times that even the lawyers that startups hire to help them develop their contracts, they just don't know enough about software as an asset class or as a product class. So it's actually important to invest. And one of the areas for all the companies that I've founded, I've never skimped on my legal team or my legal fees. I've always invested in good legal representation so that even if I'm working with larger companies who have more resources, I'm on an equal footing about how the negotiations work. And that's actually quite important for a startup.
That's interesting. So you're saying by having the right service provider or the right help, you have leverage in these agreements. So, I mean, it's a very good idea to invest in maybe a top law firm or accounting firm or that very early on, even if you couldn't afford it, in order to get the right price in so that your company can grow?
Yeah, and the right legal firm, once you've gone through a few of these agreements, you'll start to get the pattern and you'll start to establish the structure. And so subsequent negotiations can take some time, but they're actually easier. The other area in which a startup can gain some strength is your board. If you have an effective board, someone in that board will have had experience in negotiating complex deals. And so you want to make sure that as you're building out your board, you're building a board member, at least one board member who has negotiation experience.
How would you go about asking for that help? I mean, as a founder, wouldn't you be intimidated asking your board to help on early contracts?
I always laugh about, I'm smiling and laughing because I find that when I need help, starting with "I need help" is a magical phrase. And you'd be surprised as a startup founder, how powerful being open and honest about the phrase "I need help." And I led with "I need help" quite a lot. And people are willing to help you if you ask very simply and very directly, "I need help." And I would sometimes put it in the subject line of the emails I would send to my advisors. "I need help negotiating my license with BMW. I need help responding to the security audit from Cisco." And that subject line captures exactly what I need. I'd put it in the email, send it to my advisors, and you'd get help.
So going back, I mean, we are talking about pricing, but so far it sounds like it's only been for software. What about for services or physical products? Is there a difference there?
Well, when you look at where the world is headed, we've got software-enabled solutions, and we define a software-enabled solution as any solution in which software represents a material part of the solution. It could be hardware and embedded systems where you've got a piece of hardware, but the software is making it useful. We saw in the tech showcase, for example, some of the startups, they have sensor technology or they have IoT technology. In terms of the services market, you're seeing humans augmented with software services, sometimes AI, sometimes other elements of software that will enable the human to perform more effectively. So for us, software pricing and licensing includes anything that's a software-enabled solution.
Are there current possible models out there that maybe you found VCs in Silicon Valley too obsessed with?
Yeah, I'm really glad that you asked that. One of the things that we're seeing in the market is we're seeing everyone running towards MRR, or monthly recurring revenue. And there's a big concern that we have at Applied Frameworks about MRR-based models. And I'll give you a really concrete example. One of our relationships is with the VC firm Companion Ventures, and they run their portfolio companies through our growth pricing workshops. One of their portfolio companies is a company called Noify, and Noify creates construction management software. When we started working with them, 20% of their new customers were coming in on an annual license. By the time we were done with them, we had more than 60% of their customers coming in on an annual license. Now think about what that does financially. Run the numbers. First, you're pulling in a full year of revenue right up front. So you're changing the amount of cash that you're pulling in. You have to recognize that revenue over time, but you're pulling in cash right up front. More importantly, when you're working in the B2B and B2P markets, and sometimes in the B2C market, when you're doing monthly recurring revenue, you have greater churn, because if people are paying you monthly and you're not producing a result fast enough, they churn away. But if they sign a one-year license, you have enough time to engage in the behavioral and operational changes that are needed to get the value out of that software. So not only did we pull in a significant upfront amount of cash, we were able to significantly reduce their churn because their customers were using the software long enough to see the benefit of the operational changes that were required. And I think that right now we've got too many people in the industry pushing MRR, and I prefer to look at ARR and contract ARR, or CARR, how much contracted annual revenue you could have. And then for my own companies, at the last company I started and sold, we tried very hard to get 3-year licenses, not 1 year, but 3-year licenses. We found that was a real sweet spot. And then by the time we went into the negotiation, our software had improved. So going into the negotiation, we were able to increase our price after the term, not decrease our price, because we had enough money so that we could actually justify a higher price through more enhanced functionality.
So question with that pricing model right there. From my understanding, so many VCs and investors love that monthly recurring revenue because it's okay, it's a month to sign them on. There'll be very short negotiations. People will try it out. An annual contract, wouldn't that negotiation be so lengthy, so time-consuming, it's not possible for companies? Or is this just a fallacy?
No, I concede that many times an annual license, especially in the B2B market, B2B and B2P market, can actually take a fair amount of time. Probably the longest license that I negotiated, it took 18 months with the Austrian Chamber of Commerce. But by using the Austrian Chamber of Commerce as a distribution model, we were able to substantially expand our market share in Europe. Similarly, I mentioned that we had signed a contract with BMW. That took 14 months to negotiate. I'm going to counter with the prize of having that large of a customer and that large of a contract was worth the time it took to negotiate. Now, if you're working with a large client like a BMW, we found that over the course of the negotiation, we were able to pull some of that revenue in through services, and we were actually able to create some license agreements where there was limited use of our software. So I want everyone in the audience who's thinking about these larger or longer term licenses and are a little concerned about the amount of time it's going to take to negotiate. It's a valid concern, but you can be creative in the structuring of the deal, and you can pull revenue in such a way that you're pulling in some of that benefit to both you and to your customer.
Now, you had mentioned going back to them after that 3-year time and being able to negotiate that new contract where it wasn't a discounted price, it was increased because they saw the value. With that, I mean, before maybe 3 years, maybe earlier, when are good times for a company to renegotiate or reevaluate their current price and model?
Yeah, one of the other problems that startups make is that once they set a price that seems to be working, they don't revisit that model. And the way we think about pricing model changes is what we call triggers. And there are 3 primary triggers for any company out there, not just startups. The first trigger is time. If you haven't looked at your pricing model in the last 6 months and you're a growing company, you're waiting too long. As you're growing, as you're expanding, as you're improving, you need to be looking every 6 months. If you're a more mature company, it should be at least once a year. And even if it's nothing more than inflation adjustments, those are material. The second class of triggers are external triggers, things like regulatory changes or competitive changes in the landscape or supplier changes. And of course, the third class of triggers are your own company's improvements to your software or to your solution. If you are improving your software, and chances are pretty good that you are, then you should look at your pricing model so that you can charge more over time. And again, that ties back to your legal agreements. Even if you're a B2C company, you want to structure your click-through agreements and your legal agreements so that you have the right to adjust your pricing according to market conditions.
Now, one area that might be of real interest for the startups here is so many of the companies here in Saudi Arabia are going to look to expand into other markets. How do you go about thinking of the price model when you've already have it established in one country going into another, especially if those countries may be different economic kind of status?
Yeah, if you think about the complexities of launching a startup in your own country, and then you think about how you might expand globally, it can feel overwhelming. There are 2 strategies that I have recommended and I have found value in, both in my own career and with the clients I consult with. The first strategy is to keep the prices uniform. Just, this is our price. We don't really negotiate. We don't really adjust it. And here's our price. That can work okay for lower priced items or even in the B2C market. For other negotiations, you need a reference standard. And what we have recommended and what we find useful is the United Nations Human Development Index. And UNHDI adjusted pricing is a fair model because it represents an external standard. Instead of arguing about an opinion, you can use the UNHDI as a reference standard, and it ranks countries around the world based on their economic strength and their economic structure. So you'd find countries like Northern European countries, the United States, Canada, Saudi Arabia, you'd find that they would rank very high on the UNHDI. You would find other countries around the world ranking lower, and it's a way to fairly adjust prices to local conditions. And again, you have to be careful about this because if you're a Saudi-based company and you're serving a global market or you're serving in the B2B market a company that has headquarters but global operations, now you're back into, I think I might want to negotiate that price. You may still allow for some regional differences, but you want to have a global perspective on the pricing.
Now, we have about a minute left. Luke, can you share a story of a company that you've worked with?
Well, we talked about Notify. That was one of our customers. Another company that we worked with at Companion Ventures was Fullcast. And they had such a novel solution that using benchmarking data was really hard, and using market research with their customers was really challenging because there was no good reference for the novelty of their solution. So when they came to us, they said, well, how do we price this? I said, well, here's what you're going to do. You're going to pull down the pricing off your web page, and every deal for the first few deals, you're just going to negotiate, and you're just going to keep raising the price 10%. And we're going to use actual negotiations with your customers to calibrate when the price is too high. And it actually worked. It took a little bit of time, but rather than what the founder thought was the price, we were just able to increase the price until customers started saying no, and then we knew what a fair price was.
And Luke, if anyone in our audience wants to learn more about what you're working on, what's the best way to go about doing that?
You can get me on LinkedIn. You can find us at appliedframeworks.com.
Fantastic. And when I'm not moderating panels, I'm the host of the Silicon Valley podcast. Please subscribe. Check it out if you want to find out what's happened in Silicon Valley at all times. And when I'm not doing that, I'm an investment banker focused on mergers, acquisition, and growth capital. And I'd like to thank our audience for taking the time to be present in this panel. So thank everyone.
Thank you.